In this session, we will describe how the US financial industry is organized. We will introduce the most important bank and non-bank financial institutions and explain their roles in the economy. The modern financial industry consists of financial markets and financial institutions. Some firms offer brokerage services that connect savers and borrowers directly in financial markets. Other financial firms, we have been calling them financial institutions, raise funds from savers and use the proceeds to invest in a variety of financial instruments: stocks, loans, bonds, and real estate. These financial institutions have balance sheets. Our goal in this session is to identify and characterize the most important financial institutions. Who are they? What are their unique economic functions? How do they raise funds? Where do they deploy these funds? Put differently, what do their balance sheets look like? And finally, which of these institutions matter most in terms of market share? Let's open up the financial institutions box. We first make the distinction between banks and non-banks. Banks are the financial institutions that we interact with on a day-to-day basis. These include commercial banks, savings institutions, and credit unions. In different countries, there are other types of banks, but they all do the same thing. They collect deposits from savers and grant loans to borrowers. Banks are not the whole story here. We are going to see that non-banks play an important role, and their presence has undoubtedly been increasing. What is a non-bank? Well, at a first pass, these are financial institutions that do not take deposits. The key types in the United States in terms of assets under management include insurance companies, pension funds, securities firms, finance companies, and government-sponsored enterprises. This is a very big umbrella, and these institutions are very different. They have varied funding profiles, varied investment profiles, and the underlying economics of why these institutions exist also varies greatly. Let's start with banks. We have commercial banks, savings and loans institutions, and credit unions. They all play a similar role in finance, and their balance sheets reflect this. They raise funds primarily from retail customers, these are savers like you and me, in the form of deposit accounts. These are our bank accounts. Some large banks also borrow in debt markets. You may have heard of the interbank market or the repo market. How do they use these funds? Well, banks mostly invest in loans. In fact, banks are the primary originators of loans in the economy. Banks decide which households get a mortgage, the size of the loan, and the interest rate. What makes banks special? Why do we like banks? Well, banks are a combination of businesses. Depositors, that's us, we get bank accounts that are safe, convenient, and offer access to the payment system. Banks themselves pool our savings, in fact, large amounts of small savings, and make loans to credit-worthy borrowers. Finding those credit-worthy borrowers and granting them loans is what we mean by origination. Banks also trade in financial markets on behalf of their customers. This allows us to diversify our risks and manage our wealth into the future. Let's take a look at some recent data from the World Bank. We can calculate the size of domestic securities markets. This is stock market capitalization plus the total value of outstanding bonds, and compare this with total loans outstanding. This comparison will give us a rough sense of the relative importance of banks, since banks grant the bulk of loans, as compared with securities markets all around the world. Here is the data for the United States, Europe, and 2 Asian economies over the past quarter century. What are the key takeaways? First, in all of these economies, both securities and loan markets are important. This means that banks are highly relevant, which is probably not surprising to you. Second, there are a lot of differences around the world. In the United States, finance is less dependent on banks, whereas in China, the reverse is true. Moving on to our non-banks. First fact, non-banks are not funded by government-insured deposits. This is probably the loosest definition that I can offer. These non-banks perform many of the same economic functions as regular banks. They can provide a safe and convenient way to store wealth. They channel pools of small savings to borrowers. They minimize information costs associated with investments, and some of them allow customers to reduce risk. There is a vast ecosystem of non-banks, from peer-to-peer lenders to pawnbrokers to private equity firms, and of course we have the rise of fintech in recent times.